December 11th, 2025. Silver trades near 61 per ounce after hitting an all-time high yesterday following the Federal Reserve's rate decision, up roughly 110% year-to-date according to multiple market sources, the best annual performance since 1979. And Wall Street is finally saying the word they've avoided for months: parabolic. I'm not a financial advisor. This isn't financial advice. This is an urgent technical and fundamental analysis of what is unfolding as silver enters what traders call the parabolic zone, a price acceleration phase that historically precedes either explosive continuation or violent correction. Based on publicly available market data, institutional reports, and real-time trading patterns across global exchanges, here's what you need to understand immediately. The technical pattern that just printed is the same one that appeared 5 other times in silver ETF history. 4 of those 5 times marked major peaks. But one time, it signaled the beginning of the most violent rally on record. The difference this time is that the fundamentals underneath aren't speculative, they're mathematical. BTIG's chief markets technician Jonathan Krinsky warned that silver has gone parabolic, pointing out that the iShares Silver Trust posted 3 straight daily gains of 2.5% or more in the past week, something that has only happened 5 other times since 2006. Let me be clear about what this means. When an asset goes parabolic, when it enters that vertical acceleration phase, it doesn't obey normal rules anymore. Support levels become suggestions, resistance levels evaporate, price discovery breaks. Look at the chart structure. Analysts are identifying a historic breakout from a 50-plus year cup and handle formation. And one of the most reliable bullish patterns in technical analysis when it appears on multi-decade timeframes. This isn't a momentum trade. This is a structural repricing event that's been building for half a century. Yesterday, December 10th, silver climbed to a record high of 61.95 per ounce following the Fed's 3rd consecutive rate cut. The metal cleared every prior resistance level. The January 1980 peak near 67.31 adjusted for futures contracts. The 2011 high around $49, all of them breached. Clean breakouts with volume confirmation. And here's what's terrifying or exhilarating depending on your position. There's nothing but air above current levels. The momentum indicators are flashing extremes. Economic Times reports a 4-hour RSI above 80, with prices stretched far above the 50-day and 200-day moving averages. In normal technical analysis, RSI above 70 signals overbought conditions, a sell signal. But in parabolic markets, RSI can remain above 70 for weeks or months as price continues accelerating. The indicator doesn't predict tops in parabolic moves. It just confirms you're in one. Technical analysts are now targeting the 161.8% Fibonacci extension level at $65,717 as the next upside projection. Some more aggressive forecasts suggest potential moves towards $70, $100 within 12-18 months, if the structural dynamics persist. But here's the critical question. Is this a blow-off top before a collapse? Or the beginning of a multi-year bull market that Wall Street has feared since the supply deficits began? Wall Street doesn't use the word parabolic lightly. It's code. It means we've lost control of the narrative, and the institutional buying patterns confirm they're scrambling. The iShares Silver Trust has taken in over $1 billion in fresh capital over the past year, with assets under management now approaching $30 billion. The trust manages approximately 519 million ounces of silver, roughly 60% of an entire year's worth of global mine production. Think about that concentration. One ETF controls more silver than most countries produce in a decade. And institutions are competing for positions. Bank of America raised its 12-month silver target to $65 per ounce in October 2025, calling silver the tightest major metal market of 2025. UBS projects potential for $70 if Fed easing accelerates. ETF holdings have grown by over 90 million ounces year to date, indicating continued institutional participation, even at elevated price levels. Here's what makes this institutional buying different from retail speculation. These aren't momentum chasers hoping to flip positions. These are asset managers running supply deficit models and calculating exposure ratios. Bank of America's commodity outlook noted that lower real yields, persistent ETF inflows, constrained mine output, and resilient industrial demand continue to underpin silver's advance. They're buying because the math says they have to. And look at the short positioning. Short interest in the iShares Silver Trust is hovering around 9.6% of the float, relatively high for a commodity vehicle. In a rising parabolic market, this creates rocket fuel. As prices break resistance levels, shorts are forced to cover, creating additional buying pressure that accelerates the move higher. It's a feedback loop that feeds on itself until something breaks. The professional options market is pricing in continued volatility, Recent projections suggest global solar installations could require over 5,000 tons of silver annually just for photovoltaic applications, with electric vehicle production targeting 20 million units annually, each consuming 25-50 grams. Industrial buyers are building strategic stockpiles, paying premiums to lock in supply months ahead. That's not speculation, that's survival. Every parabolic move needs fuel, and silver's fuel is a mathematical deficit that cannot be resolved quickly. The Silver Institute projects that 2026 will mark the 5th consecutive year of a structural supply deficit, with a roughly 95 million ounce shortfall expected, and a cumulative deficit of about 820 million ounces. Since 2021, roughly equivalent to an entire year of global mine production consumed from existing stockpiles. These aren't projections, subject to revision. These are actual inventory drawdowns measured in vaults. The London Bullion Market Association reported available silver inventories contracted substantially, with holdings in London vaults falling from about 31,023 tons in June 2022 to 22,126 tons by March 2025, a decline of roughly one-third. Physical metal disappearing from the system while prices double, that's not a bubble, that's supply destruction meeting demand acceleration. And the demand drivers are accelerating, not moderating. Solar manufacturers are transitioning from older PERC technology to newer TOPCon and HJT cells, which require 120% more silver per watt. This technological shift means that even if solar installation growth were to slow, silver consumption per installation is increasing. The thrifting mechanism that normally kicks in when commodity prices rise, where manufacturers reduce usage, has been reversed by technology requirements. Silver is on track for its best year since 1979, when the Hunt brothers' attempt to corner the silver market sent prices vertical, with only 9 S&P 500 companies outperforming silver's 110% gain this year. But here's the critical difference from 1980. The Hunt brothers were creating artificial scarcity through manipulation. Today's scarcity is organic. It is the result of years of underinvestment in mining colliding with an explosion in industrial applications that cannot be substituted. Roughly 70% of silver production comes as a byproduct of copper, zinc, lead, and gold mining. When those primary metals become less profitable, silver production falls regardless of silver prices. The supply response is structurally broken. This makes silver fundamentally different from commodities, where higher prices reliably bring new supply online. Here's where the technical and fundamental analysis converge into something potentially explosive. The gold-silver ratio now sits near 70, with commodity analyst Tim Hack indicating it could crash to 45 in mere weeks, a shift historically associated with violent silver outperformance. Let's unpack that ratio. With gold trading around $4,200 per ounce, a 70-to-1 ratio puts silver at $60, fair value by historical standards. But during periods of silver outperformance, that ratio compresses dramatically. At a 60-to-1 ratio, the historical average, silver would trade around $70. At a 30-to-1 ratio, seen during supply stress periods, silver approaches $140. At the 15-to-1 ratio briefly touched in 1980, we're talking about silver above $280. Even after doubling this year, silver still trades roughly 80% below its inflation-adjusted 1980 peak. Adjusted for inflation, the 1980 high of $50 would equal approximately $180 to $200 in today's dollars. That's the gap. That's the mathematical potential if this becomes a true supply squeeze rather than just a momentum trade. And the ratio compression is already accelerating. Silver has outperformed gold by nearly 2-to-1 in 2025. Year to date, silver has posted gains of approximately 95%, significantly outpacing gold's 60% rise. That outperformance typically happens late in precious metals bull markets, when investors recognize silver's leverage and industrial necessity simultaneously. What Wall Street feared wasn't silver going up. It was silver going parabolic while being structurally short. And that fear just materialized. The paper silver market operates on ratios. For every ounce of physical silver, there are dozens. Some estimates suggest over 100. Claims in the form of futures contracts, options, and over-the-counter derivatives. Most settle in cash. The system works beautifully until it doesn't. Until industrial users demand physical delivery. Until ETF holders question whether their shares represent actual metal. Until the paper claims exceed the physical supply by so much that confidence cracks. And we're seeing early signs of stress. Futures pricing showed physical scarcity with pronounced squeezes in the physical market, visible draws in benchmark stocks, and constrained London spot availability. Backwardation, where spot prices trade higher than futures prices, appeared repeatedly throughout 2025. That inversion signals immediate physical demand overwhelming future supply expectations. The professional commodity traders know what this pattern means. They've seen it before. In 2008, during the financial crisis, physical silver disappeared from retail markets entirely despite paper prices showing only moderate gains. In 2011, premiums exploded to 25-30% above spot as mints couldn't keep up with demand. In 2020, the disconnect between paper and physical created week-long delays even for major institutional buyers. Today's pattern looks more severe than all of those episodes because it's happening with structural deficits, not temporary panic buying. The vaults are emptying during what should be normal market conditions. Imagine what happens when recognition hits mainstream, when retail investors mobilize, when the evening news shows lines outside coin shops. Parabolic moves don't usually start in December. Seasonally, December is strong for precious metals, but vertical accelerations typically happen during crisis periods. March 2020, September 2008, January 1980. We're not in an obvious crisis. Economic data is mixed. Equity markets remain elevated. Yet silver is behaving like it's front-running something. The Federal Reserve delivered an expected rate cut on December 10th, lowering rates to 3.5%, 3.75%, maintaining its outlook for just one cut in 2026. That's marginally dovish, but not dramatically so. Yet silver rallied to record highs on the news. The market is responding to the direction of policy, lower rates ahead, not the specific magnitude. And lower rates historically correlate with higher precious metals. Prices as the opportunity cost of holding non-yielding assets declines. Analysts note that December traditionally sees gold and silver rally together, and recent seasonality patterns support continued strength. But here's what's unusual. Parabolic moves that begin in strong seasonal periods and are supported by fundamental deficits tend to continue longer than purely technical breakouts. The combination of timing, fundamentals, and technical structure creates a powerful cocktail. Technical forecast indicates a breakout continuation remains likely while price stays above short-term demand zones, with the key support level now established in the 59.60 range. As long as price holds above the breakout zone, momentum is expected to continue toward higher targets. The pattern suggests this isn't a blow-off top, but rather the beginning of a larger repricing event. And here's the pattern that matters most. When assets break multi-decade resistance levels on high volume with fundamental support, they tend to consolidate at elevated levels rather than crash back to previous ranges. The market reprices to a new regime. Several research pieces suggest silver averaging in the mid-50s in 2026, with upside scenarios toward the 65-95 area if deficits persist. That's not boom and bust speculation. That's structural repricing. Let me be brutally honest about what comes next. Parabolic moves end badly. Always. The question isn't whether silver will correct. The question is whether the correction comes from $65, from $75, or from 100 plus, and whether the correction is a healthy 20-30% pullback in an ongoing bull market, or a devastating 50% plus collapse back toward previous ranges. 4 of the 5 previous times that silver ETFs posted 3 consecutive daily gains of 2.5% or more, it occurred either at or right before a major peak. That historical pattern is screaming caution. Vertical moves attract momentum buyers who disappear the moment price stalls. Leverage unwinds violently. Profits get taken. And assets that went up like rockets can come down like anvils. The technical indicators are stretched to extremes. RSI above 80 doesn't mean buy more. It means this is unsustainable. The distance above moving averages creates a rubber band that wants to snap back. Short-term traders should absolutely be thinking about risk management, stop losses, and position sizing appropriate for extreme volatility. But here's the counter-argument that keeps institutional buyers accumulating through the parabolic phase. The fundamentals underneath this move are different. The combination of critically low inventories, the shift towards silver-intensive solar technologies, and a supportive Federal Reserve suggests that the floor for silver prices has likely moved higher. Even if silver corrects 20% from current levels, and for long-term investors focused on structural supply deficits and industrial necessity, timing the peak of a parabolic move might be less important than simply being positioned before mainstream recognition hits. Because once silver becomes a headline asset, once it crosses into public consciousness the way Bitcoin did in previous cycles, the flows become self-reinforcing regardless of technical extremes. The critical decision point. This is not a prediction. This is a framework for understanding what's unfolding. Silver has entered the parabolic zone. The technical pattern is clear. The fundamentals are unprecedented. The institutional positioning is aggressive, and the timeline is compressed. For those already positioned, the question is whether to take profits during vertical moves or hold through what could be a multi-year structural bull market. Professional traders would tell you to scale out, take chips off the table, protect gains. Long-term investors would tell you that trying to time parabolic moves is how you miss the largest gains. For those not yet positioned, the tactical question is more difficult. Buying assets during parabolic acceleration goes against every instinct. The headlines scream overbought, the charts look insane, the premiums are elevated. Yet some of the largest gains in commodity bull markets happen during the parabolic phase. Historically, silver outperforms gold late in precious metal cycles, and that outperformance typically happens during vertical acceleration phases that look unsustainable until they continue for months. What's undeniable is this: the designation of silver as a critical mineral is driving strategic stockpiling, with fundamentals pointing to a structural bull market that is only just beginning to emerge. Whether we're at the beginning, middle, or end of the parabolic phase will only be clear in hindsight. What's clear right now is that silver is no longer acting like a commodity. It's acting like a monetary asset in shortage during a period of expanding monetary supply. And historically, that combination produces moves that defy logic until they don't. Today, December 11th, with silver consolidating near record highs after yesterday's explosive move, we're at an inflection point. The parabolic pattern is established. The fundamentals support continuation. But the technical extremes suggest vulnerability to any shift in sentiment, any hawkish surprise from central banks, any temporary easing of physical tightness. Professional risk managers and commodity analysts warn that silver's small market size makes it prone to violent swings in both directions. The same leverage that drives explosive upside can trigger sharp corrections when leveraged positions unwind. Volatility is not just likely, it's guaranteed. But volatility cuts both ways. And for those who understand the structural deficit, who recognize the industrial demand trajectory, who see the supply constraints that cannot be resolved quickly, volatility might be the cost of admission to the most significant commodity repricing event of the decade. The parabolic zone is not a comfortable place. It's where fortunes are made and lost in hours rather than weeks. It's where emotional discipline matters more than analysis. It's where the market separates those who understand risk from those who chase returns. Silver just entered that zone. Wall Street's fear became reality. And what comes next will be studied in trading textbooks for decades, either as the blow-off top that marked the end of a speculative mania, or as the beginning of the supply squeeze that redefined precious metals markets for a generation. The breakout Wall Street feared isn't coming. It's here, right now. And the only question that matters is whether you understand what that means before the window closes completely. This is not a drill. This is price discovery in real time. And the market doesn't wait for anyone to be ready.